Yeah.
Yeah.
Anyway, so after I've done the bit.
Okay. Bye.
And is it the last show today?
No.
No.
We have two more books. We got Assist next week, and then we have something completely different, a new app on the market.
You've got to put your camera up higher. Can I see like a quarter of your head?
Right, Simon, can you check if we're live on Facebook? Because I can't see this damn thing going on any.
It says it's live on customer streaming.
If someone can go to Facebook. Yeah, it looks like. Hang on. Sorry, I got Heathrow landing. 1 sec.
Yeah, it's live. Should go. Ready to go?
Sorry, go time, Simon. Off we go. I'm going to get ready.
Good afternoon, everybody. Welcome to the Thursday edition of the Property Professional Show. As per normal, it's on a Thursday every week at 5 o'clock. We are going for at least a couple more weeks before the summer break. So we've got special guests today joining us and the usual panel as well to answer your property questions. So as you know, with Inside Property Professionals, we're a like-minded bunch of individuals across many different sectors. We try and bring special guests in to share, network, ideas. We've just come out of a lockdown, so it was great to actually attend a real property event yesterday live in person. Some of us don't quite approve of that yet, but some of us do. So it's nice to see some of my co-hosts in person for the first time in 15 months yesterday, to actually be out and about and mixing with other property individuals. So watch this space to see where Property Professionals is going for September. We'll make some decisions over the summer whether we're going to carry online for a bit or what we're going to do, because as soon as we started face-to-face show, we went straight into a lockdown. So yeah, a bit of a challenge that was, but we got through it anyway. So we're a non-profit making organisation, and we invite guests on the show to share their ideas, their property experience in how to help you build your property portfolio successfully. On the panel today, we have my co-host. Everyone knows Dill, party wall guy. Say hi, Dill.
Hi, Dill.
Who helps grill the panelists, and we're here to answer your questions. We pose a few questions as well to our host. To our special guest, who we will kick off with today, that way round. So, Bhupinder, do you want to introduce Bhupinder, Dill, or shall I?
I'll let you introduce him, but all I can say is I'm going to behave myself because we've got a really great speaker today. And as I say every week, put away your colouring pencils, get your pens out, take some good notes. Really honoured to have a top-class IFA here, but I'll let you do the formal introductions because I always muck those up. Simon, off you go.
Okay then. So just so you're aware of who our special guest is today, it's always better if we tell you. So he's Bhupinder Anand, who of Anand Financial Architecture. It's an IFA service based in Uxbridge, alongside Anand Wills and Trusts. He connects law, tax, financial planning to try and provide that one-stop estate planning service. He is highly awarded UK Independent Financial Advisor of the Year and rated Evening Standard Best IFA in the capital. He's in the finance editor of Eastern Eye newspaper and presented his own finance series on Zee TV. He's a 25-year member of the $1 Million Round Table Association, representing the world's best 50,000 advisors. So I could keep going, but he's got a huge background, huge knowledge, huge skills. So please listen to what he has to say, because I think all of our viewers is going to benefit from his discussions today. So over to you, Bhupinder. Thank you for joining us and giving us your time.
Thank you, Simon. Thank you for that introduction, and I might add a bit of gloss to that as well as we move on. I'd like to do a screen share. Can someone give me a host rights?
Only because it's you, Bhupinder.
Got it.
If it was anybody else, I'd ask them to put £1 in the meter.
Yeah, I'll give you more than £1. It's fine.
There you go.
I'm honoured. Okay, so I've got a lot to cover. And as a result of that, I'm going to talk fairly quickly. And what I'm going to do is, rather than pausing for questions, I want to get through what I want to explain and then note down your questions, and we'll have some questions at the end of it. But I just really want to dive in pretty deep, pretty quickly. So I want to talk about estate planning. But, you know, this word estate planning, it means so many things to different people, different things to different people. And a lot of it is about theory, but people don't know how to apply the theory. What I want to talk about is, how do you read an article and then try and make sense of it as to what it might mean for you? I'm also going to show you that trying to implement it yourself is probably a very difficult thing to do. Simon gave me a glowing introduction just a moment ago, but if I can just add a couple of things to that, if I may, that on top of being an IFA based in London, I actually speak at conferences all around the world. My largest audience was 12,000 people, which was a great warm-up for this session today. So I'm really honored that I did that. But name a country and I've probably spoken around there, training other financial advisors, and I've twice won the UK award for IFA, Independent Financial Advisor of the Year. I've also written a book. So I'm an author as well, and I also coach financial advisors all around the world on how to run better businesses. Now, before I came along to this session, I had a drink with my friend. We're allowed to now because they're out of lockdown, with my friend Einstein. I said to Einstein, I'm going to be meeting some incredible people at the Property Professionals Group. Is there a message that you would like me to share with people that are watching this video? And Einstein said to me, can I share the following with you? Which is, problems we face cannot be solved at the same level of thinking we were at when we created them. Let me explain what I mean by that, or what Einstein means by that, my friend Einstein. It's not that I can change you in my presentation, or that I can do anything for you in my presentation, but my motive in this presentation is to raise your level of thinking. Raise your level of belief that things that you thought could not be done can actually be done, because there are a million things on estate planning that you've never even heard about. We're going to cover some of those today. First thing I want to do is just explain my positioning on this and give some credibility to the fact that why should I be invited to talk on this subject? So yes, I run Anand Financial Architecture. I've been doing that for nearly 30 years as a financial advisor. But over that time, I used to introduce my clients to solicitors. Now, solicitors who are watching this are not going to like what I'm about to say, but I've yet to find one to argue with me. I used to introduce my clients to solicitors to write their wills, until I realized that what solicitors typically do is that they take instructions and then deliver a document that reflects your instructions. There's no advice and there's no creativity. And what I came to realize, the reason for that was that in order to do so, they'd have to talk about tax. And they can't talk about tax. They're not trained, they're not licensed or authorized. They really evade the word tax, if that's the right word to use. And they'll say, go and talk to an accountant. And then my observation about working with accountants, with all due respect to them, most of them don't get involved in inheritance tax planning on a frequent enough basis to know enough about it. They know what it is, but they don't know how to deal with it necessarily. And they know nothing about law or financial planning. So then you go and see a financial advisor, and I'm allowed to say what I'm about to say because I train financial advisors. So I have a good idea of what most of them are like. And I'm going to put to you most of them in the space of estate planning can't spell the words law or tax, usually just trying to sell something. That's when I set up a second business called Anand Wills and Trusts. And what that allows me to do is within the two businesses, occupy a unique space where I can give advice that covers law, tax, and financial planning. And you will see the effect of being able to do that in the presentation that I'm going to be sharing with you. Why is that relevant to you that I occupy that space? Because you get joined up thinking. You don't have to go and see 3 different professionals who will confuse you, contradict you, and dare I say, because I've seen it many times, if something goes wrong, they'll blame each other. And so the advice I give is holistic. It covers both estate planning in the context of financial planning and wills and trusts. Both businesses carry full professional indemnity insurance, so you know you're protected with any of the advice I give you. Clearly, today, I have to caveat, I'm not giving advice. No one should do anything based upon what I've said, but I'm hoping to raise your level of thinking to start thinking in a different way about the things you could be doing. So let's start with some theory. You see, when we talk about estate planning, most people think about estate planning as tax. How do I avoid this horrible 40% inheritance tax? And the next thing they think about when it comes to estate planning is tax. How do I avoid that 40% tax? Next, they move on to thinking about tax. And eventually, they'll get around to talking about tax. Estate planning is far more than just talking about tax. And tax seems to be the limitation of most people's level of thinking, that I need to find a way of avoiding the tax. I wanted to start thinking in a broader way than that. See, estate planning reality is actually how do we pass our wealth down the generations? And how do we do that so that our wealth stays with the generations and reduces tax along the way? It's not just about tax. It's how we distribute and leave a legacy for our family, both our children now, our grandchildren, and beyond. So I want to concentrate on that part of it first, and then I'll talk about how do we reduce the tax liabilities as we go on. Because I'm talking to a fairly learned audience, I am going to make some assumptions that people are familiar with some of the jargon, but nevertheless, warning you, there is still going to be jargon. Not because I want to confuse you, but I just want you to be aware there's a lot to know in this space. Don't try and do it yourself. If we're talking about estate planning strategies, and particularly tax avoidance strategies for inheritance tax, the first one is dead easy, on paper at least. Don't own anything. Because if you don't own it, on death, it won't get taxed. Clearly, for a lot of people, that's not very practical, because if you're going to give it away, that's got implications such as you can't use it anymore. If it's producing an income, you can't have the income anymore. And to give things away, normally you need liquidity. There are other things you can do, which I'm not going to spend time on today, such as giving the growth away. So you could lend money, say to a trust, whereby you are entitled to get the money back, but the growth belongs to the trust and it's outside of your estate for inheritance tax. By the way, I'm presuming everybody's familiar with the tax rate of 40%. I'm just going to admit Steve, because I'm host. The tax rate of 40% that's applied after an allowance of 325,000. There is a further allowance of 175,000 in respect of property. But I'm going to imagine that most property people that are doing very well that are watching this are actually not going to get that extra residential nil rate band, because if your estate is over 2 million, you start losing that 175. So if your estate's more than 2.35, more than 2.35, you lose all of the extra 175. Apologies that I'm talking very fast. It's just because I want to get through a lot of material to raise your level of thinking, as I keep saying. DGT stands for discounted gifts trust. You can give monies away and 60-70% of it immediately leaves you. There's none of this 7-year rule that you may have heard about. And the rest gives you an income for the rest of your life. So interesting ways of dealing with that. Business property relief or business relief qualifying assets. You can invest in certain assets that after just 2 years of ownership, qualify for 100% exemption for inheritance tax. Again, not the subject of today, that's possibly another day, but very, very clever things that you can do whereby you don't even lose control. They still remain in your own name, but they're not going to get counted for inheritance tax. Or you can choose to pay the tax, but pay it at a discount. Now, I want to concentrate on the presentation today about the top and bottom things on those lists. As I said, these are not the only things you could be doing. There are many more things, but we've got limited time. I'm going to be talking about trusts, and I'm going to explain how they work, and I'm going to explain how they can benefit you. But before we do that, I want to scare you a little bit, because you might think I could read up on trusts and know everything about it. Well, in order to know it, you need to know about the taxation on trusts and all of this jargon, which I'm not going to explain all today, because again, we could do a whole technical session on what is a periodic charge and what is a PET, nothing to do with animals, is a potentially exempt transfer. And what's holdover relief? I will be talking about that. So trusts are fantastic devices, but you've got to know what the tax liabilities on those are, and then how do you deal with those tax liabilities? I want to start first of all on the subject of this, how do you protect your wealth down the generations? Now I'm hoping, but I don't expect, that everybody watching this has got a will. If we had a Q&A, I'd ask a question right now, who has actually got a will? Now, if you haven't, that in itself is a pretty dangerous thing, particularly if you've got young children, young meaning under the age of 18. Forget your assets, you need a will to appoint guardians in case the worst happened and both you and your spouse or partner died in a car accident together. Who's going to look after your children? In the absence of a will, it will possibly be social services care, which I'm sure you would not want. But otherwise, if you have got a will, typically one that a solicitor's written for you, or you've done off the shelf yourself for 20 quid, you'll end up with this kind of scenario. That you've got a bunch of children. By the way, this doesn't mean you have to have 5 children for this. This could be the same child several times. I'm just using several faces to illustrate the point. And the average ordinary will say the following, that when both parties go, because first of all, first party goes, it goes sideways, second one to die, it then goes down to children. That's a typical will, nothing wrong with it. It's just not very good. It just does a job. Let's imagine now what would happen if you had £1 million or several £1 million of wealth, or any wealth for that matter, passing down to your children. You are not doing them any favors. For example, you've given your kids a great education, you've given them a great start in life, they've gone into good work, and maybe they are 40% taxpayers. And you have left your property portfolio to them. They're going to pay 40% income tax on that rent, when they may say, actually, that's a complete waste of me having to deal with that property. I'm already paying 40%. Why did my parents leave me more wealth? By leaving more wealth, you also introduce more problems. Because what if your son or daughter that received this wealth didn't get their own affairs in order and died young, but was married? Well, their wealth could end up with their ex-spouse, who may be young enough to go off and get married again, and the wealth that you left them could disappear. What if you left your wealth under a will to a child who's also got married, but gets divorced? These things happen. Half of your wealth could disappear just because you left it to a human being. What if they have creditor problems? What if they go into business and take out mortgages and loans and the business fails? Then money you have left them, your wealth that you've left them, could disappear by being called in by creditors. What if they need care in the future and you've given them wealth? Then the local authority may not support them, may not provide that kind of care because it will be means tested. Let's say nothing happens to them, like these negative things. Whatever you've left to them after you've paid your 40% tax, remember, I'm talking about your estate planning first, then the tax on your estate planning. After you've paid your inheritance tax and left it down, guess what? Your kids will then pay 40% when they die. So what's the solution to this? This is life. This is what happens if you don't plan. The solution I have is that we, upon our demise, should never leave our children anything. What do I mean by that? A very common thing to say is, I work for my family, I work for my children. I'm going to say to you, don't leave your kids anything. Instead, leave it inside a trust. So your will, instead of appointing assets to human beings, your children, appoints assets to trusts. Your children are the managers of those trusts and the beneficiaries of those trusts, but it's not in their name. And the beauty of it not being in their name, but being under their control, means it's not at risk. I call this bloodline planning, protecting your wealth down your family bloodline. Because the other people on the family bloodline could be a spouse where if a child dies young, it can't cross this brick wall of the bloodline. It's only there for his or her children. And if there aren't any, maybe your other children. What if you've got a child that got divorced and you've left them wealth in a trust? A spouse has no access to it because he or she will not be a beneficiary to that trust. What if the creditors come along and say, we can see that you've got £1 million in that trust, we want it? Well, first of all, they can't see it because it's a private document, so they don't know what's in it at all. But even if they could, your son or daughter could say, get lost, it's not mine, it belongs to this trust. Same applies to care costs, and the same eventually applies for inheritance tax. Anything inside a trust can never be attacked for 40% inheritance tax ever again. This is what a good will should be doing. And I've yet to see a solicitor write a decent will, because in order to do so, they're going to have to start talking about tax. And as I explained, they can't do so. So getting the structure right first is arguably more important than dealing with the tax. We can deal with the tax, but if your structure is broadly wrong, the tax is irrelevant. So I talked about trusts. I'm going to give you a quick, very, very quick look through how a trust works and some of the things that you might do with it. I use discretionary trust. The word discretion means the trustees, the managers of the trust, have the discretion as to who they can give assets to. Those assets can go to a limited number of people that are what's called the potential beneficiaries. Okay, imagine a trust as a shoebox is the way I like to think of it. You open the lid and you put something in, you put the lid down tight. You then give the shoebox away to a manager that's called a trustee, and their job is to manage what's inside there and occasionally open the lid and give it out to a beneficiary. You putting it in will be called the settlor. This could be during your lifetime, or as already described, could be under your will. So we're not necessarily talking about you giving something away. A lot of people get confused here. When I start talking about trust, they think I'm going to give something away. You may. I'm talking about under your will. Your will sends assets to a trust. You're the settlor. And you put money in at that point. As a settlor, you appoint a trustee, usually your family members, maybe a professional trustee as well, whose job it is to manage that trust. And if it's property in there, they'll manage the property. If it's cash, they'll manage the cash or investments. Who are they managing it for? Are the beneficiaries. Who are the beneficiaries? The beneficiaries are appointed by the settlor and are usually the following order of priority: spouse, children, and then we call remoter issue. Remoter issue means children of children of children. It keeps going down generations. You know, the landed gentry, the aristocracy of this country, have been using trusts for hundreds of years to keep their wealth. All these stately homes, they're not held by any human beings. They're held by trusts. And every time a lord or lady dies, or a duke, the Duke of Edinburgh passed away. The Duke of Westminster is a good example, who owns Mayfair. He died in 2016. It then turned out he didn't actually own anything. Everyone thought he was a billionaire. It was the Grosvenor Estate Trust that owns the whole of Mayfair. As a result, the Duke of Westminster's inheritance tax bill was a big fat zero. So trusts are not a new thing or an aggressive thing. These have been going for hundreds of years. We now need to learn how to apply this to ourselves and use the same laws that have been running for hundreds of years, and they're not just for millionaires or billionaires. And then you have reserve beneficiaries, where if there's nobody in the family bloodline left, who else could it be? A charity, nieces, nephews, whatever you might want it to be. Key point is that a set law, the person who puts it in, really important to understand this, a set law cannot be a beneficiary. So once it's gone in, it's a gift and it's gone forever. But a set law can be a trustee, which means they're in control of what's in there. And when they've passed away, the beneficiary can be a trustee. To give some guidance to the trustees, the set law would also issue something called a memorandum of wishes, which is a guidance document. Remember, trustees can exercise discretion, but they would normally look at the memo of wishes to say, is this what the set law wanted to do? What could the trustees do? They could appoint income or capital to one of the beneficiaries. Note, if it's income, say it's a property in the trust, and the income is being paid to one of the beneficiaries, it's taxed on the recipient beneficiary at their tax rate. That's very powerful for property people to get their head around this, and I'll come on to how you could use that to your advantage. So income and capital is taxed on the beneficiary, not the trust, if it's appointed to them. But what if there's cash in the trust? It would be very little point in giving that out to a beneficiary, because then we're back to square one on that bloodline sketch. What was the purpose of the trust? So if there's cash, what the trustees can do is give interest-free loans to the beneficiaries. No credit searches, no credit history, no monthly payments, but loans to beneficiaries repayable when the beneficiary dies. Very clever tax planning, because it then reduces that beneficiary's own estate, because that money must go back to the trust. That saves 40% on the size of the loan. And the next line of beneficiary, maybe your grandchildren, can step up, become the new beneficiaries, and they can take a loan. So that same money goes round and round every generation. Let me give you an example of what I mean by that. Let's say you had an estate worth £1 million after your allowances, and you've paid 40% tax. That means if you left your wealth directly under a normal will, you're going to leave £600,000. But that individual, because you've given them cash in their pocket, assuming they still have it on death, it hasn't gone up and it hasn't gone down, they're going to pay another 40%. So now that money's going to drop down to 360. Next generation pays another 40%. And after a few generations, there's hardly anything left from that million. However, if you've used a trust under your will, I can't avoid the 40% yet. I'm coming on to that. But the 40% is still payable. So the million loses 400, but 600 has now gone to the trust. But because loans will be taken and repaid, it's always 600,000. So your legacy sustains value down the generations just by one simple exercise. What's the point of you creating all these big property portfolios if you run the risk of losing them as they go down the generations? And every time somebody takes a £600,000 loan, because they owe it back to the trust on death, and it reduces their estate. I know I'm talking very quickly, forgive me, but we can talk privately about this and what it means for you. But that 600,000 as a debt at 40% means there's a £240,000 tax saving for the next generation, who then step up and they borrow the money. And because they've borrowed it, there's a debt on their estate, which saves 240,000. So not only are we sustaining the 600,000, we're reducing every generation's tax bill by 240,000 on these numbers. Now imagine if these numbers were even bigger. I mentioned about rent inside a trust. So as property people, this may appeal to you. Did you know? Actually, let me rewind that did you know question. If you've got children, can you remember your children's very first words? You're probably going to say it was mama, papa, something like that. I know what your children's very first words were. As soon as they were born was, where's my tax allowance? Because from the moment a child is born, they have a personal allowance of £12,500. They don't have to reach 16 or 18. It's from that second. And yet most people don't know that. They think it's at 16 or 18, or even if they do know that, they don't know how to give their children income. Because if parents give their children income, it's still taxed on the parent. But if we use a trust to pass down wealth maybe to grandchildren, so let's say a property goes into a trust, either a gift during lifetime or ultimately under the will. And let's say it's kicking out £10,000 of income, rent. And you appoint, if you kept it in the trust will pay 45%. Ouch, you're not going to do that. You would appoint it out to a beneficiary because we know the beneficiary is going to pay the tax, not the trust. But if that beneficiary is a minor child and you give them £10,000, it's tax-free. So whereas giving it to one of your own children who might be a high rate taxpayer would have meant the 10K would have gone to 6, by giving it to your children, your grandchildren, sorry, they can now pay their own school fees or tuition or toys or books, clothing, holidays, everything that you have paid for your children from taxed income. Imagine if your children didn't have to pay tax to pay the same things for their children. This is the kind of clever things we can do with trust and with property. So moving on to the tax itself. So we've got the structure right. We've got the will and it's pointing down to trusts. Now we've got to deal with that 40% that's going to go before anything goes to those trusts. So I prefer to talk about inheritance tax by calling it a debt on your estate. Yeah, a lot of people they ignore the word tax. And when I say to them, you have a debt on your estate, they say, no, I've paid off all my mortgages. I've got no debts, no liabilities. Yes, you do. You owe 40% of what you're worth on your death to the taxman, to the government. So you do carry this debt, even though you may feel that you don't. Now, as property people, you're going to hate me for the next visual I'm going to show you, but I've got to show you. If you've got a property portfolio of, say, 5 properties, and I ask you how many properties you've got, you say, I've got 5 properties. I'm going to put to you, no, you haven't. You only own 3 of those 5. And they said, no, I've got the deeds of all 5. I paid off the mortgages. They're all mine. No, they're not. 2 of them are being set aside to pay the tax on all 5 of them. So 2 of them belong to the taxman. On 2 of them, not only are you holding the deeds for the taxman, you're also giving him a share of the rent that you're working hard to collect. How do you feel about that? 2 out of every 5 properties do not belong to you. I know you hate me for saying that, but you've got to really get your heads around that. The planning that I do is to say, well, if I took the rent off one of these as if you never had it, most people would say that wouldn't bother them. They could still live on the 4. I could take the rent from one and protect that 40% across everything else. Just need to explore how we could have done that. But really get your head around, is it worth you building up a bigger property portfolio if you don't plan how you're going to exit the planet? You know, exit the planet is a word I use quite often. All of us, we don't have a freehold on life. We have a leasehold. It's just that we don't know the term of that lease. It's in God's hands. Sometimes we're lucky enough that the lease is renewed when something goes wrong. But one day that lease is going to get called in. That's out of our control. But what is in our control is how do we leave the planet, not when do we leave the planet. Do we leave the planet in better financial condition for our children, safe and secure, or do we leave a financial mess? I'm putting to you, that's a choice you're making. You either choose to leave it in good order or you choose to leave a financial mess. And the typical attitude, especially an Asian attitude, I find is, I don't want to talk about death because somehow talking about it brings it closer. Really? Where's the science for that? We've got to talk about this because if you're avoiding the subject, you are making a choice. You are choosing to leave a mess. If you're happy with that and you have the peace of mind that you're going to leave a mess, good for you. Most people don't want to do that. So here's a key point. When we're doing some calculations, I've chosen these numbers on purpose just to illustrate the point. Let's say your estate value is 3.15 million. The numbers are not important, it's the principle here. You would have a nil rate band of allowance of husband and wife, 325,000 each, which is 650,000. Note, you don't have $1 million because the estate value is over 2 million. Okay, you would have had $1 million if your estate value was below 2 million. The net estate, we call it, is 2.5 million, and 40% tax on that, ouch, is £1 million that your children have to find before they can actually sell any of the assets. So they have to go to a bank who's going to charge through the nose for that loan in order to pay the tax man, who will then release the assets in order to sell them, and hoping you can sell them quickly so that you can have the money to pay back the bank. But £1 million lost to the estate. Or is it? My calculations here say the loss to the estate is £1 million. It's worse than that. You see, prior to that, what was the £1 million doing? If it was property, let's say, and you were getting 5% rent, not only have you lost the property of £1 million to pay the tax, you've lost that 50k a year of rent. How long for? Forever. So let's get to understand how nasty this tax really is. It's not just the figure itself, it's the loss of income attached to that figure. If you're happy about that and you want to leave a mess for your family, so be it. Most people, when they get their head around that, are not happy to do that. So what could you do? I talked earlier on about reducing your estate, giving things away. Now, this assumes that you can. Not everybody can, because they might need it for themselves. There's two ways of giving your estate away, either directly to your children, which introduces all those bloodline risks that I talked about, or giving to a trust in the way that I talked about. Note, caveat, there is a limit on how much you can actually give to a trust, which is 325,000 per person, who's the settlor, every 7 years. So you are fairly limited. And the idea is, with any kind of tax planning like this, start as young as possible so that you've got more 7-year chances to actually deal with this. So if you left your wealth directly, you start the 7-year clock. It's called a PET, a potentially exempt transfer. If you die within 7 years, that asset is still inside of your estate. If the asset was property, you would, even though you made no money from it, but gave it to somebody, trigger capital gains tax. I'll come on to that because a lot of people don't realize this. You might think I made no money, I didn't sell it. Nevertheless, you disposed of it, you pay capital gains tax. And once you've given it away, you've lost control. It's not yours. You can't say or do anything about it, including, and this is a pitfall that people fall over, you have permanently lost the income from that property. And of course, because you've given it directly to a human being, you've introduced all those risks that if you've given it to a son or daughter and they got divorced, half of that property could disappear. A trust is a protective device. It doesn't get rid of the 7-year clock. It's still the same principle, but it's called a chargeable lifetime transfer, the CLT. It's like a PET, but because it's a trust, it's called a CLT. If you have got a property that you paid, say, 100,000 and it's gone up to 250,000, ordinarily, if you give it away, that profit of 150,000 is taxed at 28%, up to 28%. If, however, you gift that property that we call pregnant with gain, so you paid 100, it's worth 250, it's pregnant with 150 of gain, we move that into a trust, you can claim something called holdover relief. Holdover relief essentially says, I'm not paying that tax, I'm passing the problem to the trust. The trust now holds a property pregnant with gain, which if the trust sells it, it will pay tax from a base price of 100. Not the 250 it got it for. But at least you're not paying it. You're passing it down the line, and if it never gets sold, then the CGT will never get charged. You can be a trustee, which gives you the full control of who the rent should go to. You can't have it yourself, but at least you can direct who it's going to. And if you're giving it to a child who then you don't want to give it to for whatever reason, then you can pull the plug and say, I'm giving it to someone else. And as I explained earlier on, depending on who the beneficiary is that receives it, it's potentially tax-free income. So if you're a 40% taxpayer and owning property, you're paying 40% on rent, but you could afford to give it away, you could cut that 40% to zero. 40% tax to zero. and with all the other protective aspects that we talked about with the bloodline planning. I do this a lot. Even if it's only part of a property, sometimes because we're limited to 325, we might gift a share of a property. So it doesn't have to be exactly 325 of property. It could be less, it could be several, or it could be part of. Okay, I've introduced a few slides here that specifically for this presentation, because I recognize that these are primarily property people that are watching this. I've been doing this for decades, and I think I've seen pretty much every mistake that people have made. So I want to share a few which no doubt anyone watching this may well have made themselves. I would bet on people that are watching this that are property people have made at least one of these mistakes. One of the things that people talk about is if I give away my house, I add my son or daughter to the house, then I started the 7-year clock for inheritance tax, and therefore it's left my estate. No, that doesn't work. That would be too easy. We would all do that. If you give something away, but you continue to enjoy it, it's called a gift with reservation. A gift with reservation, you're reserving the right to occupy the house and enjoy it. The only way that 7-year clock would start is if you then paid market rent on the entire value of the property. I had someone the other day that said, well, I only live in one room, so I'm only paying the rent for the one room. I said, really? So you share no aspect of the property? You don't use the kitchen, the bathrooms, the hallways, the lounge? No, you got to pay the full value of the property. So if you do, first of all, you got to find that money, and then the person receiving it, whoever you're gifted it to, is going to pay income tax on that rent. It gets worse, because if you've given your property away to a son or daughter who doesn't live with you, and you die, not only is it a gift with reservation on your estate, therefore the 40% tax still applies, but when it's sold, the children will pay capital gains tax because for them, it was an investment property, even though they got no rent. So don't do this. I mean, if you know people that have done it, or if you've done it yourself, we need to talk, because this is really dangerous. Not only does it fail from what you intended, you're passing a capital gains tax problem down the road. So you could pay 40% and another 28% if you haven't structured this properly. Ouch. People have buy-to-let property and they give it away to a child and say, okay, I've given it away. I've started my 7-year clock. Seen that all the time, but they don't tell the taxman they gave it away because they say, I didn't get any money for it. It was a gift. Why should I pay tax on a gift? That's not how the taxman looks at it. The taxman says you disposed of value, therefore you are chargeable to tax. This is ridiculous when you see this kind of thing happen. And if that's years down the road that you then realize, not only are you paying interest and penalties on top of that as well. Don't do things like this without taking advice. Again, and solicitors are going to hate me, but they won't argue with me. If you go to a solicitor and say, I want to add my son to my mortgage, they will add your son to the mortgage. They will not tell you the implications of doing so, or adding your son or daughter to a property. They'll just do it because that's what you wanted. But there's implications because it's a gift. The other mistake that property people have is they keep remortgaging. They keep putting more money into new property, have very little equity. And part of the problem that is when I then say to them, what's your exit strategy? It's, I'm going to sell, but they don't realize they're storing up capital gains for the future. And there may not be enough equity to pay that capital gains, because gains is from purchase price to value, nothing to do with the debt. So if you've kept taking debt and you've got very little equity, you can end up as your retirement strategy, not being able to sell the property. And also by not having liquidity, you limit your ability to do something about inheritance tax planning. So one of the things you could do is create liquidity from bricks and mortar through equity release, which might be a normal mortgage, or if you're not able to get a normal mortgage because of age, equity release allows you to take a mortgage on your house where the interest is rolled up and the lender gets repaid when you die and the property's sold or the children find a way of paying it back. So it's a way of releasing the equity in your house to then do some planning with. Another mistake that people make is they give away their investment property, done. given it away, even if they have declared it for capital gains, but then they keep the rent for themselves. And they say, oh, no, I haven't done anything wrong. I'm even declaring the rent. Well, from a gift with reservation aspect, your 7-year clock never started because you're enjoying that property. It's amazing the stories I hear of what people have done. And they think they're doing it really well because they're declaring the rent. That's the worst thing you could be doing. The rent belongs to the owner. Otherwise, you are still the owner for tax purposes, and the other person's an owner for their inheritance tax and their capital gains tax. You can double up the taxes if you don't do this properly. What if you want to help your children on a property ladder or anything else, and you give them cash? You give them cash, you've created that problem of the bloodline risk. If you're going to give cash to a child, you put the cash into a trust, and the child takes an interest-free loan from the cash to then go and do what they want to. But because they owe that money back, you've not made them asset rich. So do not make cash gifts to your children. You've got to do it through a trust. Many people buy student property. Their son or daughter is going to university. Rather than them paying rent, I'll buy a property and I'll put my son or daughter on the property. And therefore, we'll save, as a family, save the rent on that property. You're missing a trick, because as far as you're concerned, you've got an investment property. If, however, we used a trust to say that you bought it on behalf of your child and the child occupies it, the trust can use the child's principal private residence relief, so that when you sell it, there's no capital gains. Compared to if you bought it and your child lived in it directly, when you sell it and it's gone up in value, you pay capital gains. Use a trust, use the child's principal private residence relief, you pay no capital gains either. Now, if you've done that, bought a property for a child, we can even go back over time and declare that that was always your intention. You just never got around to doing the documents. Some clever planning. What about your exit strategy? No time for it today, but I can set up corporate structures for your property whereby the shares of the company are held by trusts. That way, you can redirect dividends to beneficiaries of the trust, because dividends would go to the trust, and the value of the company is outside of your estate. But you are a director of the company and a trustee of the trust. You've got complete control. Very sophisticated, not for everybody, it's not cheap, but if you're going to build a property portfolio, get it right before you start. It's a lot harder to fix it after you've created your wealth. So very, very fast, I did that presentation, probably the fastest I've ever done it, but I hope you found some value and benefit, if only to sow the seed of some ideas. If this is of interest, join me on your estate planning journey. Allow me to take you through the various steps that we do for our clients of getting deeper dive into your personal planning, helping you to think about the different strategies and prioritize those strategies, and then drafting and creating those documents for you. If you want to contact me, I have two companies, as I said, Anand Financial Architecture in Uxbridge and Anand Wills and Trusts. And my email address is my first name, Bhupinder, Bhupinder, at anandassociates.com, ANAND associates.com. At the beginning of my presentation, I told you about the fact that I had met my friend Einstein for a quick drink and what he said, a message that he wanted me to pass along. I hope I've done that for you. I hope I've helped you to recognize that the problems you face that you may not even realize you faced, and I apologize if I have made you open your eyes up to problems you've created now, but to fix them, we have to raise our level of thinking. It is not something to put your head in the sand about. It is not something that you can ignore and hoping the problem will go away. It'll just get worse. So I hope to have raised your level of thinking. If I have, and you want to join me on the journey, get in touch and we'll have some fun along the way. Thank you very much for inviting me to the group. Real privilege and honor to be here. I appreciate it.
Thank you, Bhupinder. That was a fabulous presentation. So I'm taking it all in as we speak, actually. So as I was a regulated wealth advisor from 98 to 2013, and then I retired from that side because you have to spend so much of your time providing regulated wealth advice, and I was doing many other things. So I had to make a choice between the two. So one, and you quite clearly demonstrate why you have to spend 85% of your time doing this, because it's such a clear pathway to saving tax, but how many people do it? And the number of clients I had that used to frustrate me when you give them a will pack and it stays in their top tray forever, and you can't get them to fill it out for love nor money, because sometimes they don't know what to do with it. But
Sure.
I was
the other problem, Simon, is when people try to do it themselves. That's what I find a big issue, and undoing messes is half the thing that I do.
Yeah. Well, the will pack was when I was in the bank, we used to have a pack which we fill out, and then it was sent away to be drawn up as a will. But you're actually just giving some sort of instructions down. But again, there is no advice in the packs of how to do it. It's just what you think's a good idea. Yeah, I'll leave some property to John and Jane or whoever, and that's me done, and they can pay the tax. And yeah, some of the things you highlight there are quite obvious, but they're quite clearly not, because so many people are not doing it. And that's the really I know quite a lot about the bloodlines. I see that quite a lot, especially with, you see divorce cases and the mess that causes behind. So I love the idea of the interest-free loans. I think it's a great idea, and keeping the money inside that bloodline is something that I think is paramount. You know, you go through divorce. A lot of people go through divorce. I think it's over 1 in 2 now. So used to be 1 in 3. Now it's down to 1 in 2. So that's a 50% chance you're going to get a divorce, and then the money's gone because it's in the marriage. And you know,
should we open up to any other questions? Got a few minutes.
Yeah. No, about the trust side, how easy is it to do that in terms of costs? In terms of
it's a great question and an obvious question, and one that's really difficult to answer.
Is it?
Okay. The reason being, I don't know how many trusts somebody might need, because the size of their estate will determine how many trusts. For example, I mentioned the periodic charge. I didn't explain what it is, but in a nutshell, the periodic charge is a charge on a trust every 10 years, because a taxman can't get 40%. They have a different tax. But you can spread your wealth amongst several trusts because each trust has an allowance. So it's really hard to say how many. Typically, I charge £485 for one trust, but the more you do, the cheaper they become. You start getting volume discounts.
That's interesting. I mean, when you put that in context, the £485 trust, it really is nothing, and it's a one-off charge that people are going to make to set it up, and it's
and there's no annual fees.
I know, but we were just talking about the bloodline. I mean, that's really where I was going with the question, really. I know it's a bit of a long-winded question, but it also needs to reflect back on all the information you just gave away to people to just save millions of pounds, essentially, in tax over lifetimes. And something I hadn't even considered was not only do you lose the house, you're losing 50 grand of income from rent.
It's scary, isn't it?
That's the shocking bit.
But it's true.
Yeah.
Right.
That's the bit people need to be.
So I've raised your level of thinking, Simon.
I know, absolutely, because you just get out of practice. As I said at the start of the show, we were on a property event last night, and I was talking to probably 10, 20 people last night with portfolios way in excess of £5 million, and I bet they've all done nothing about it. I bet
they've done no planning.
Yeah, I know. It's so rare to find property people to actually do the planning.
And they're the worst, with respect to everyone watching. But
Well,
they're
they
the
want to
worst.
do,
Right?
and then it makes it even worse because they just want to make more money.
But I come back to, out of
And
every
then-
5, 2 don't belong to you.
Absolutely, I love that
So-
analogy.
So, you know, what I
Right.
struggle with this. Why go and do more if you haven't fixed the problem on what you got?
Yeah, I think Dil and Surinder might have a
Yeah.
question.
Bhupinder, if you could share your slide details and just to sum up, I think Simon is shocked to a level of almost speechlessness. And for him, 485 is a good round of drinks. So it's a bargain if that's where it starts from. If you can put your details on. Surinder, I think you've probably got a question because I think you've made a... don't tell us one of your dodgy stories, but if you could ask a useful question, Surinder.
No, as you went through your presentation, you talked about people giving property to their children and things like that before to start the 7-year process.
Yes.
You said you can undo that. How
No, I didn't say undo it. I could fix it.
Fix it, yes. Well, fix the problem.
Yeah.
So, what sort of process does that involve?
Obviously, detail matters, such as where did the rent go, who paid what taxes, what capital gains. But I can use something called a historical trust, a historical deed. And what that does is you look at something and say, does it have the hallmarks of a trust? Okay, if it does, then we could argue you always intended this, you just never got around to documenting it. So the best example being you bought a property for a daughter to go to university to live in. And your intention was always to sell it. You didn't really charge any rent on it. And if you did, it was nominal to the other tenants that you might be sharing with. But otherwise, the purpose was, I'm going to buy it for 3 to 5 years and I'm going to sell it. And it's gone up in value in that time, and you're going to pay capital gains tax. To me, you bought it for your daughter. Okay, the minute you say I bought it for someone, you're starting to go into territories of trust. I'm doing something for someone else. I'm holding it, but the beneficiary is my daughter.
Right.
So I'm a settlor and I'm a trustee. The beneficiary is my daughter. That's the hallmarks of a trust. Now, when it comes to capital gains, what you can do in a trust is look through the trust and say, if a beneficiary is occupying the property, the beneficiary has their own private residential relief. You know, your own home is not subject to capital gains tax. And because the beneficiary was occupying that, the trustees can say, well, I'm riding on the back of that principal private residence relief, and therefore I've got no CGT to pay.
Okay.
It's really clever.
Yeah. Makes sense.
And then it's in the trust. And if you do sell it, then the cash can come out by way of a loan, or it could be used to buy another property or retain the property.
Thank you.
Every case is different.
Of course, the details will be different in how you deal with it. That's Over to you, Dil. Have you got any?
Yeah, I got loads of questions, but I don't think we're going to get them answered. So, Bhupinder.
I've got 5 minutes if you want to carry over time, or you're not allowed to.
No, we could carry over time. It's I think you've got a next appointment. So
I've got an appointment on the football pitch. I'm off to play footy.
Stay away from that. Could be dangerous, especially if you're England playing Italy. But anyway, just a quick question. You said that people give away, add their children on and carry on living in the property. Is that the case where it's their main residence and the children still live with their property, or is that something slightly different?
Well, there is one caveat. One caveat. If your child lives with you and will always live with you, that's a big challenge always, then you can put their name on it. There's a particular clause in the legislation that allows a parent to gift their property to a child or share of the property to a child and start the 7-year clock and not be a gift with reservation. However, it's really hard to meet the criteria because the minute that child moves out, it's back into your estate. So yes, it works, but to maintain it for the rest of your life, You've got to be very clear on that.
Yeah. Okay.
But yeah, again, I wouldn't assume it is the point. There's still planning and documentation needed. Don't just say, I can put my son on it and therefore I'm taking advantage of this. If you don't even know the clause, how do you take advantage of it?
Yeah. And the other point you made that was really, really interesting, and we see this a lot in the Asian community, is where they give money to buy a house.
Yeah.
If you can elaborate a little bit more on that. And that is obviously, from what you've just said, wrong way to do it.
Well, it's not an ideal way to do it. The point being, the minute you give wealth to your family, to your children, you introduce risk. That's the starting point of it. If you make your children wealthy, you run the risk that wealth could disappear from all the risks that I talked about.
Sure.
The way you would do it, let's say I was giving 100,000. I would gift that to a trust. So I set up a shoebox, call it my trust. I'm going to put that 100,000 in there, open a bank account and put it in there. I've done my job. I've made a gift. I can be a trustee, so I still control it. And for my son or daughter, I then give them from the trust an interest-free loan. So they pay no monthly payments. There's no credit history or credit searches around it, and they've got access to the money. But because they always owe that money back, I've not really added to their estate. Do you follow that, Doug? Because I've given them 100,000, but they owe 100,000.
Yeah, yeah.
So their net estate has not been improved. Yeah, there's a philosophy I carry which might help here. Wealth is there to use and enjoy, but not necessarily to own. That's what we really want, is the use of and the enjoyment of wealth, but we don't necessarily need to own it. And that's what trusts allow you to do.
Very clever.
Yep. And so, you know, in the sort of some of the financial press, sometimes you come across stories that are saying, well, the anti-avoidance are doing this, they're outlawing trusts, you can't do X, Y, Z anymore. Any general comments on that, or specific comments on any of those?
There is no anti-avoidance in the space that I'm talking about. This is tried and tested. If you want to start doing offshore trusts and aggressive things, not my space. I don't get involved in anything like that. And yeah, if you do that, you may get a knock on your door from HMRC at 6 o'clock in the morning. The stuff I do is not in the gray area. It's in the white area, we call it. You know, black area being tax evasion, gray area being loopholes. The stuff I do works, and we're not bending the rules, but we're using the rules as written. So you're always going to find articles that are negative about something, always. Yep. Dodgy landlords, does that mean all landlords are bad? No.
Well, you know what we're going to say on this group. I think it's the other way around, actually, but the pendulum's obviously swung against landlords for various reasons. So.
Well, and that's a whole separate debate for another day of, is property a good investment? But this is not the right forum as a property forum to be doing that. What I would say is diversification is more important.
Okay. So just to touch on that, when you say diversification, you mean non-property assets and
liquidity.
Liquidity, yeah. And talking about liquidity, there was an interesting, and we see it being done all the time, where they carry on remortgaging, buying more and more property, and occasionally the children get hold of some of the money and go and buy a Ferrari. And what you're saying is that's basically storing up capital gains tax and various other issues.
Think about it. You buy something for 100K, it grows up to 150K, and you take 30K of extra mortgage out. And you keep doing that every time it goes up. But if you've got very little equity, but your gain is measured from 100, so it's gone up to 500,000, and you've got a loan of, say, I don't know, 450 on it, even if that's possible, 400. But your gain's going to be measured on 400,000 from the 100 to the 500,000, which 28% is about 120 grand. But I got a property of 500 with a 400 mortgage. Where do I find the 120?
Yeah.
I'll get 100 of equity, I still owe 20. Where do I get that from? And if all I do is use the equity to pay the tax, what was the point?
Exactly. So yes, I was having a very interesting conversation this morning. Yeah. So yes, and I guess what you could sum up is, in the Indian culture, there's a saying. It says, "Jo aaya unne jana." Basically, the saying, whoever comes on this planet will depart. And in the in the Western culture or the English culture, the saying is something like, "The only things certain in life are death and taxes." And I guess that's where you get the difference in the attitude. And it's something that...
The only thing certain in life is death.
Yeah.
Taxes can be a choice.
Taxes can be a choice. Yeah, obviously in your hands, that's going to get amended.
Yeah. Death is not a choice. It's going to happen.
Yeah.
Right. But I come back to my choice of how I leave my wealth, how I leave the planet is my choice.
Brilliant. No, it's a great presentation. Really like the slides. And I'm glad you found a time machine to go back and visit Einstein. So we'll get some more Einstein. Will you promise to come back and give us some more Einstein tips next time? Or you could have another time travel.
I would love to. Otherwise, people could just Google my name or YouTube my name. They'll see some of my videos, including me when I did my 12,000 people audience in Vancouver. There's loads of stuff out there. You'll be there for hours. But yeah, thank you for the invitation this time. And yeah, when you feel it's enough of a gap that people have got over me and they've forgotten me, let's do it again.
Brilliant. Simon, have you got have you woken up from the shock that Bhupinder's delivered to you?
No. I was be good to get him back and highlight some of those points again, because I just see it so often through all the years. Any further thoughts there, Bob?
Yeah. Thank you, Bhupinder, for coming on the show. That was very, very useful, as always. Can you just explain that property isn't seen as a business? So even though you might hold shares in a company that owns a lot of property, you don't get the business property relief, do you?
No, you don't. No. Okay. So really quickly, in the presentation, I mentioned business property relief as being where you own assets that after 2 years of ownership, even though they're in your own name, they're outside of your estate for inheritance tax. But that only applies to trading businesses.
That's right.
Not investment companies. So a trading company is buying something, selling it,
yeah,
or it's a service of some sort.
So any property developer who does flipping, for example.
Yeah, development is an activity of trade.
Yeah.
Okay, so if I'm buying, I'm not getting rental income, I'm buying, improving, selling, that's a trade. That's a trading activity. The share value, and one wonders what the share value would ever be in those type of companies, right? But because if they're taking the money out by way of dividends, what's left? But anyway, the share value is in the estate. It's not in the estate, sorry, it's exempt. If it's a property company where it's purely renting, and we'll talk about the hybrid in a minute, but if it's purely renting, it's called an investment company. It does not qualify for any of that relief.
Correct.
The gray area comes where you've got a bit of development and a bit of renting. And this pendulum, somebody used the word pendulum just a while ago. It's where does that pendulum lie? And if more than 50% of either your revenue, it's getting really technical. If more than 50% of either your revenue or your asset value is in the investment side, the whole company becomes investment. Okay, you get no BPR relief. If it's less than 50%, then that amount is not exempt. Okay, so your 50% point is really important.
Yeah.
But yeah, sometimes I see a lot of these property forums where they're saying, oh, you incorporation relief and move your portfolio properties into a company and you get lots of inheritance tax benefits. I don't believe it at all. You might get the IHT benefit for one generation. It's not fixing what I'm talking about, which is generations to come.
Yeah, that's right. And also, I think the banking and lenders are nowhere near as sophisticated as they need to be to cope with what you're planning or doing, because they don't like trusts for a start.
Yeah, that is a negative.
It's a negative. So yeah. You know, as soon as you mention that you want to do a buy-to-let or a purchase in a trust environment, they run a mile, and very few lenders are in that space at the moment, and they do tend to charge a little bit more for it. So,
yeah, but Bob, if you pay a bit more, but you're saving hundreds of thousands in tax, does it matter?
Yeah, long term, if you extrapolate the future growth, of course, but
when I notice this with property people, they will quibble with great mortgage brokers like of Bob over a 0.25% difference on an interest rate, but they don't care about paying 40% on everything they got.
Even less.
Yeah, right. They'll have a fight with you. Why are you charging me 0.25 more than Joe Bloggs down the road, right? But Joe Bloggs' tax man's going to take 40% of your wealth. Oh, that doesn't matter. I'm not interested in that. It's Bob's overcharging me on the best mortgage. Rubbish.
I know.
Got the wrong perspective.
Yeah. And obviously, you've just given us a very good angle on lending money to children to buy property. Because, the trust arrangement really, really works quite powerfully. But we have lenders, not many, just one or two, that will allow the parents to take a second charge on the house. So
in that case, the trust would take the second charge.
Because
the trust is the lender, not the parent. Yeah.
So again, lenders don't like trusts. So, with the cases that we have done, the parents have actually taken a second charge on the house.
Oh, I see. By doing it that way, right?
Yeah. So they have some control over that money they've lent, not gifted. So that's not left their estate.
Well, they make a gift, but they've still got a charge over the property. So technically, it's a gift.
Yeah. But no, it's not a gift. It's a charge. There's a differential in wording there.
Yeah. But then it's an asset still in their name, isn't it? So from inheritance tax, that fails.
Yeah, exactly. Yeah. So that's what I'm saying. From an IHT viewpoint, the trust is still the better vehicle. But interesting. Thank you very much, Bhupinder.
My pleasure. I hope people have enjoyed this, and if there's anything I can do to help anybody, give me a call. We'll have a conversation. First meeting's always at my expense, and then we can explore ideas and see if I can help you. And if I can, I'll quote you a fee, and you'll know what it is. And then you say, I want to go ahead. And if you don't, no worries.
Thank you.
Great. Thank you very much.
My
pleasure. Enjoy the rest of your evening. I'm putting my kit on.
Just before you go, who do you play for?
Oh, it's just a bunch of guys. We've been playing for 20 years every week. It's a keep fit. It's not a team.
It's not proper football, is it?
Oh, you tell them that. Just show you my injuries.
And by the way, don't tell them I said that, because I think they might be after some blood. I'm already in trouble. Right. Folks, what an interesting session that was. And I think Simon and everybody's going to agree with me on that. Talking about the subject of taxes, we've got the man with the Russian alphabet behind his name next week, I think. Is that right, Surinder?
Yes, as far as I know, he's confirmed that.
Yep. Okay, so we look forward to seeing everybody. Great session today. Thank you, Bhupinder. Super great stuff. I'm still shell-shocked, and I'm not shell-shocked with stuff. So thank you very much. We'll see everybody next week, and we might even get more broadcasting streams. This is why we had a slight differential today. See everybody. We'll look forward to seeing everybody next week, Thursday, 5 o'clock. No holidays yet, so don't disappear.
Okay, thank you.
Right. Thanks, Dale. Thanks, everybody.
Bye-bye. Bye-bye.